Most people work 8 to 10 hours a day. They wake up tired, rush through traffic, spend their best years building someone else's business, and still feel like they're barely keeping up. At the same time, almost everyone has the same quiet dream: to travel more, to spend real time with family, to work on something they actually enjoy. But they stay stuck to a paycheck because the moment they stop working, the income stops. And that's the trap. What if your income didn't depend on your daily presence? What if money kept coming whether you were working, resting, or away from your laptop? There are 5 proven ways to build passive income. Income that works independently of your time. And today, I'll break down each of them honestly, without hype, without promises of easy money, with real pros and real risks. My name is Stefan, and you're watching Passive Logic. I've been investing for over 20 years, and for more than a decade, my main source of income has been dividends and long-term assets, not a salary. Before we talk about methods, let's clear up one important thing: what passive income really is. Passive income is often misunderstood. It does not mean zero effort. It does not mean instant results. Passive income means this: you don't need to trade your time every single day to keep earning. If you work a job, your income is active. No work and no pay. Passive income continues even when you step away. You can work, you can travel, you can take a break. The income doesn't disappear. That's the key difference. The reason most people never build passive income isn't laziness, it's confusion. There's too much noise online and very little real education. That's why so many people fall into scams that use the same words: investing, freedom, passive income. So let's talk about real options that still matter in 2026. 1. Business. A properly built business can become a source of passive income, but only if it's systemized. There are 2 realistic approaches. First option, you build a business yourself, create processes, hire managers, and remove yourself from daily operations. You don't disappear. You review reports, adjust strategy. But you're not handling daily tasks. Second option, you invest capital into someone else's business and receive a share of net profit without operational involvement. This approach has the highest upside and also the highest risk, because when you invest into one specific business, you inherit all of its risks. Markets change, consumer behavior shifts, unexpected events happen. A business that looks stable for years can struggle very quickly. 2. Real estate. Real estate is one of the oldest and most trusted sources of passive income. You can rent out apartments, office spaces, warehouses, commercial units. The main advantage is stability. Physical assets don't vanish overnight, but real estate has limitations: high entry cost, low flexibility, moderate returns. Historically, property prices grow roughly at the pace of inflation. Rental income usually produces around 5 to 6% net annual returns. That's stable, but not exceptional. Which leads to an important question: is there a way to earn similar or higher returns with less starting capital? 3. Stocks and long-term investing. For most people, this is the most accessible and flexible path to passive income. When you buy stocks, you're not betting on charts. You're buying ownership in real businesses. The key advantages: transparency, public financial reports, regulation, diversification. Instead of risking everything on one business, you can own parts of 20, 30, 50 companies across industries and countries. Dividends are not guaranteed. Companies can reduce or pause payments during difficult periods. And that's important to understand. Risk is not a flaw, it's a feature. Without risk, returns don't exist. Stocks allow you to start small, scale gradually, and reinvest income over time, which is how compounding actually works in real life. 4. Gold and precious metals. Gold is not an income-producing asset. It doesn't pay dividends, it doesn't grow earnings, but it plays a different role. Gold protects purchasing power during inflation, currency devaluation, market instability. Investors usually hold gold as insurance, not as a primary income source. To extract value, portions are sold over time when liquidity is needed. It's defensive, not productive. Cryptocurrency. Crypto is the youngest and most volatile asset class. Prices can rise fast and fall just as fast. Like gold, crypto doesn't generate income on its own. It's primarily a speculative and diversification tool. For most long-term investors, crypto makes sense only as a small allocation, not a foundation. High potential. High risk. How much money do you actually need? This depends entirely on the asset. With stocks, you can start with the price of a single share. The moment you buy it, you become a shareholder. And when dividends are paid, you receive them. This creates a powerful mental shift. You see how small capital produces small income. Larger capital produces larger income. It's simple and scalable. Compare that to real estate, where entry often requires years of saving, and many people never reach that point. Where should you start? The right starting point depends on where you are today, not where you want to be. Many beginners avoid stocks because they feel abstract or risky. But in reality, for most people, they're the most realistic starting option. Low entry barrier, high flexibility, long-term growth potential. If you remember just one thing from this video, remember this: passive income is not about escaping work. It's about escaping dependence. You don't need to be rich to start, but you do need to start if you ever want your time back. This is Passive Logic. Subscribe if you want clear thinking, real strategies, and long-term systems, not hype. I'll see you in the next video.